Good afternoon. This is Stock Watch with Chris Pedersen on Wednesday, 20th of September, 2023. Any advice provided is general advice and may not be suitable for you. Always consult your financial advisor before making any investments. All questions from viewers should be sent to stockwatch@fnn.com.au. These are a few of my observations that are important. 1. Copper price is flat to slow drift downwards. It's now US dollars $3.73 a pound. Wasn't that long ago, it was at $4. However, it had stabilized $3.80 to $3.90. What this tells us is it's a good indicator of economic activity, and right now economic activity is not growing, exploding like we have been used to. Iron ore is still above US dollars 120 per ton. That goes against conventional wisdom. However, it is what it is, and it says that the economies are growing. Maybe it's not slowing like expected. Interest rates are steady. The ASX 200, I do not expect much of a rally until the cloud of inflation and rate rises passes. Here's a fascinating chart. This tells us a lot. I'm not going to go into all the details, but what's important is it is Cargill profits. Cargill is the largest grain commodity food processor grower in the world. Their profits recently have exploded. Inflation statistics in the US, Australia is not too different from the United States. So these charts are important. One, what we see is inflation's getting under control, which says inflation in Australia should be getting under control. This chart is inflation statistics in the US, and it's important because we follow the US, and this chart shows us a lot more than it looks like. On the left, the bar chart shows CPI excluding housing. On the right, it is the CPI including everything. There's a huge difference that if all you do is exclude housing and suddenly the CPI is the left side, which is not that much, well, just think when rents stabilize, what will happen to inflation in this country? And here, what we see is rent prices in the US, and they're plummeting in terms of percent increase. What we see in Australia is rents are also slowing. However, the big difference is there's only 1% availability of free rental housing here. There is not enough supply. Here are three companies I wanted to look at. First is Orica Limited. They had an investor day yesterday, and it closed last night at $15.88. If you look at a long-term chart, what you see is it's kind of been flatlining. However, let's look at the fundamental numbers because it's dramatically different. This is your revenue growth per year, compliments of UBS and their estimates. In 2020, revenue was $5,611 million. If you look at every year, it is increasing its revenue. In 2026, we're looking at $8.5 billion. This company has a long history of growing revenue. Now let's look at the fundamentals in terms of revenue growth, EPS, and dividend. The revenue growth estimates going forward for 2023 to 2025 is only 2.4% per annum. However, the earnings growth in that period is expected around 15% per annum, and the dividend growth also 15% per annum. The PE on next year's earnings estimate of 91 cents is only 17 times, and the yield on next year's dividend estimate of 47 cents is 3%. Free cash flow next year is expected to be around 6%, and it only has a payout ratio of 52%. Orica continues to deliver. I like the company because it has a long-term track record. I would buy it and hold. Treasury Wine Estates. I've followed this company for a long time, even when it was back at Penfolds, and it had a torturous evolution to where it is today. The code is TWE, and it closed last night at $11.52. It's had a lot of difficulty because of exports to China. And you look at the chart, it's not very conclusive as to whether it's a buy, hold, or sell. But looking at the numbers, one, it has a market cap of $8 billion. I have a 12-month price target of $13. It has a revenue growth rate for each of the next 2 years of 5%. However, its earnings are 10% per annum, and the dividend growth is 10% per annum. The PE on next year's earnings is 21 times, which is okay. The yield on next year's dividend is 3.3%, which is also okay. It has decent free cash flow at 5%. And again, it doesn't have an exorbitant payout ratio. It is one of the world's premier winemakers. Export market is the key to its growth. The weak Aussie dollar helps sales. Global wine glut right now, but it has a solid reputation, strong contracts. If it wasn't for the global wine glut, I'd buy 100% weight, but I like the company, but that risk makes it a half weight. Last company today is Medibank Private, code MPL, closed last night $3.45. This chart's also mostly sideways, a lot of volatility. Market cap is $10 billion. I have a 12-month price target, which is lower than many of the brokers out there, of $3.80. Revenue growth for each of the next 2 years is 7.5%. The earnings per share growth for the next 2 years is 3% per annum, and the dividend growth is 6% per annum. The PE on next year's earnings is 17 times. The yield is 4.9%. It has a very attractive profit margin of 16% and a payout ratio of 55%. Why I like Medibank Private is it has good revenue growth and profit margins. It's a defensive company. People always need health insurance. It's slow and steady. It's an income company. I like it as a buy. Total 12-month return, if it gets to its price target, is 10% capital growth, 5% dividend. 15% is very attractive. As always, you want to learn more about anything I covered today, more detail, send an email request to stockwatch@fnn.com.au. And if you want me to look at any of your specific companies you're curious about, I'm happy to do so. Send an email to that same email address. Thank you very much. Hope you have a profitable week.